The new JOLTS report came out this week, and it's telling us a story about 2024. Let's take a look today on the weekly update. Okay, let's talk the jobs market. Here's what you need to know. First thing, JOLTS data indicates that job openings are starting to dry up. So what we got this week, we got the JOLTS report, and basically what this tells us, it's a really good gauge of how many job openings there are out there in the country. If you look at the history, this is the history of JOLTS going all the way back to 2001, you can definitely see the impact of the pandemic, right? So as soon as we got into the pandemic, job openings dried up. And then shortly thereafter, there was this explosion of job openings. This was this explosion that we can see here. This is the so-called labor shortage, right? There weren't enough workers. And so the amount of signs out there for help wanted increased almost exponentially. Then where we are today, as we started to raise interest rates to cool off the economy, one of the things that we're seeing is job openings are starting to dry up. This is just the job opening side of things. How many workers are being demanded? And so from a peak of maybe around 12 million, give or take, the most recent number that we got was 8.7 million job openings. And you can see we've made a lot of progress in a short amount of time. So what does this tell me? This tells me that the labor market is cooling. And other jobs data corroborates my view. One of the things that I think is, I think the labor shortage has ended. And let's take a look at some charts that help show me that. Looking here, this is Indeed's data, and this is looking at the quits rate. And basically what this shows us is the quits rate is back to pre-pandemic levels. Now, what is this that we're looking at? We're looking at quits as a percentage of employment. And why this is important is because if you're scared for your job, if you don't think there's a better job out there, you're probably going to hold on to your job. And so as we get early into the pandemic, we can see that the quits rate went down pretty significantly, right? You were just happy to have a job. It may not be the best job in the world. You may not like what you're doing, but you're not going to leave it because who knows how long it's going to take to find work. Then as we enter into the stimulus era, that immediate post-pandemic period, we entered into this zone where there was a labor shortage. And so very often you could earn more money by going somewhere else. And so quits started to increase very significantly. You were very comfortable. If you left your job, you could find a better job and it probably paid better. You don't need to put up with, things at work that you didn't like. You'll just go find a better job. And so quits rates started to get very elevated here. Where we are today, interest rates are rising and the economy is slowing down. And what we're seeing is quits rate has now trended back to its pre-pandemic average. What does this tell us? Well, this is just the first of many different variables that we're looking at that tell us the labor market has finally healed from everything that happened in the pandemic. And if you think about the pandemic for a second, it's the labor market that probably got the most destroyed out of anything else. It wasn't supply chains, those fixed pretty quickly. It wasn't chip shortages, those also fixed pretty quickly. It's been labor, supply and demand of people that's taken the longest to fix. Here I've got another chart, and this is actually what the Federal Reserve actually looks at. This is job openings per unemployed worker. So what you do is you take the amount of job openings there are, you take the amount of unemployed workers, and you turn it into a ratio. And so when things are low, what this tells you is you either have a lot of unemployed workers and not too many job openings. So that would be a very weak or cool job market. When this ratio is very high, this tells you that there's an extremely hot job market out there. Basically, there's not a whole lot of unemployed workers and there's a whole bunch of job openings. What you notice is, obviously you can see, again, that similar sort of pandemic trend, but most importantly, this ratio has now finally returned to its pre-pandemic levels. And this one's important because this is what the Federal Reserve actually looks at. When the Federal Reserve says the labor market is hot, the labor market is weak, the labor market is cool, the labor market is strong, they're looking at job openings per unemployed worker. And we finally returned to our pre-pandemic average. So what does this all mean when we look at the jobs market? Well, one, job openings have dried up, indicating that the labor market is cooling. I would say you could probably talk about the labor shortage in past tense now. It's over. Just like previously where I said the inflationary episode was over, that was maybe a week or two ago, the labor shortage is over as well. The labor market, too, is rapidly returning to pre-pandemic trends, and many aspects are already there. And three, if you were to put all this together and say, what does it mean? Well, I think all of these trends, they're not just going to get back to their pre-pandemic averages and then stop there, right? One of the things that we know about economics is there tends to be a lot of momentum in economics. So if the job market is cooling, if the labor market is weakening, it's going to keep weakening even as it goes through its pre-pandemic averages. And so when you put all that together, that tells me that the economic slowdown and possibly recession, also known as AKA the landing, either hard or soft, is going to occur in 2024. I'm not saying it's going to be up, down, or sideways, good or bad, but one of the things that we know is we are landing next year. And so this is something that I'm going to be watching as I build out our portfolios for next year. So there you go. That's all about the labor market. That was the data that we got this week. I'll see you Friday for the markets review. Peace.